Ready to go.
Okay, great. I have 6:30. I'd like to convene this meeting of the Board of Directors for the San Lorenzo Valley Water District for December 4th, 2025. Leah, would you take roll, please?
President Smalley,
Here.
Director Largay,
Here.
Director Russ,
Here.
and Director Holt is remote.
Yeah, here, and I'll be off video for bandwidth reasons.
Okay, thank you. Okay, so this portion, any changes to the agenda?
There is a revision to the presentation in the agenda, which you've been given hard copies and it is now available online as well.
Okay. So are you showing us this on screen?
It will be on screen,
Okay, this revised.
this revised version.
Okay, all right. Okay. With that then, oral communications, any member of the public wishing to speak on a topic that's not on our agenda tonight, it's within the purview of the district. Seeing nobody with their hand up, nobody online, we can then proceed to no unfinished business, new business, debt financing.
So staff is looking for a recommendation from the board to direct the finance team to begin preparation of documents for the issuance of 2026 water revenue certificates of participation. That will net $16.5 million for our capital improvement projects. So in February of 2024, the board approved the Prop 218, which set the rates for justifying this debt issuance to help fund the $55 million of capital improvements that are part of the 5-year capital improvement program. Scott, if you could share your screen.
Yeah.
So hopefully this looks somewhat familiar to you. There you go. This was the approved latest version of the capital improvement projects, which was approved on June 5th of this year. That's 55 million. And then the next one. This is the current status of the projects as they stand. So we have about 1.8 million in debt financing that's active projects, which includes the Brackenbury Forest Springs consolidation and the Highland Tank, which was just awarded. In this upcoming year, we're projecting of the approved budget 9.1 million, which includes the San Lorenzo Way Bridge pipeline, fire hardening of the pump stations, Redwood Park, Echo Tank, and Harmon Street, and Brookdale Tank recoating, and Lions Slide repair. And then the year after that, we are looking to do Felton Heights Tank, something with the Charlie tank, either recoating or redesign to go around that tank. And then, of course, the CZU pipeline replacement. And all of that, that year is $5.3 million. So total, we're a little over $16.5 million in scheduled capital improvements. So staff is looking for the board to direct the finance team to begin the paperwork so that we can start the process of getting the money that we need to fund these projects. I know that Director Ruff wanted to see a Gantt chart so he can understand exactly the timeline of these things. So Scott, you can stop sharing and then I'll turn it over to Garrett.
A quick question.
Yeah.
So the 16 is the first two tally lines together.
Actually the first three dark, I don't know what color that is, kind of a beige color, is a 1.8, 9, and 5.3.
Okay, thank you.
So staff presented Gantt charts at the September engineering committee meeting.
We also included the 5-year capital improvement program. You can see there's 25 projects budgeted for the current fiscal year. There's an additional 6 projects that were budgeted for the next fiscal year. The total of these projects for this year was around 14.5 million, and then the next year was 10 million. This was all presented at the June 5th, 2025 meeting. These are the Gantt charts that we provided at the September Engineering Committee meeting. So for instance, the Bracken Bray and Forest Springs mutual consolidation. We are in construction currently with Anderson Pacific. We've completed all mainline installation up through the Caltrans bridges. We've received the Caltrans encroachment permit yesterday, which allows us to install the remaining portions of the main line on the bridges. We got a time extension from DWR for the grant till February 2026. We should be complete with the construction in January. You can also see there's the Caltrans Highway 9 house abandonments and Felton Empire trench repair project. This was awarded to Lewis and Tibbetts. We are 100% done with the construction. We filed the notice of completion at the county. The final payment will be issued to the contractor on December 30th, 2025. Highland Tank, we are under contract with Quercus Construction. We have executed a construction phase support contract with the engineer of record, Mesiti Miller Engineering. We have received the bolted steel tank submittal from the tank manufacturer, Superior Tank Company. That has been routed to the engineer of record for review and approval. That's the longest lead item for the Highland Tank project. It's a 300-day contract, and the work shall be done by October 19th, 2026. Echo Tank, Redwood Park, also kind of known as the swim tank replacement, and the spring booster pump station. We've received the 100% bid package from Mesiti Miller Engineering. Staff is putting the final touches on the specification that we will issue probably next week on our website for competitive bidding from qualified contractors. That will be a 300-day contract. So the work for that one will be done by December 2026. We have the San Lorenzo Way Bridge pipeline replacement. The county has alerted the district that we must have a temporary pipeline in place by March of 2026 to facilitate their construction. They are going in contract with Gordon Ball to replace the San Lorenzo Way Bridge. Their construction schedule shows they will be complete with the bridge by December 2026, at which point the district will have a brand new 8-inch ductile iron main installed inside the concrete box girder of the new bridge. And then we can get rid of the temporary line. Brookdale tank recoatings. We currently have an RFP on the website for a coating consultant that's an expert for coatings. Once we have the bids close on January 23rd, once we have a coating consultant under contract, we will drain the Brookdale tank for inspection and to finalize the scope of work for the repairs and recoating of the tank. The repairs and recoating, we hope that that's going to be between a 30 and 60-day contract so that the Brookdale tank is back in service as quickly as possible. And this will be conducted during the rainy season, so probably April and May. And then it'll be back online. We're going to take lessons learned from the Brookdale tank and apply that to the next recoating project. Currently, we have Blair Tank on the schedule, but it could be reorganized. We might look at Charlie Tank and save Blair Tank for a later date. It's to be decided. South Tanks is currently under design by Mesiti Miller Engineering. Now that they've finished Redwood Park and Echo and the spring booster pump station, they're going to issue a feasibility memo for the South Tanks because they've already completed the geotechnical investigation and the survey of the site, and that's the next step for that one. And then they're going to switch over to Lost Acre Tank and get the 100% designs going for that one. And then we'll see hopefully they have more budget and they can do some more work on the design of South Tank. Bennett Spring raw water pipeline and Lompico intertie pipeline burial. We've completed the survey with Tuil, and we are looking at possibly canceling the grant with the county on the burial of these two pipelines due to the constructability. These are pipelines that are passing through the woods, and so you can't get equipment along the alignment unless you make a 10-foot access road through the woods, which environmentally permitting is unfeasible. So we're going to focus our attention on other projects, most likely. CZU South distribution piping, we are getting together a big package for survey. That's the first step in developing the engineering plans. Once we have the survey together, we can do the alignment and figure out how many hydrants we're putting in, total lineal feet of pipe, and get an estimate for what the construction costs are going to be, and we can see if we have money and go out to bid for that. Pump station fire hardening, we closed the bids on the phase 1, which is the replacement of 5 wooden roofs with metal roofs. We received 3 bids. We will be bringing the contract award to the December 18th Board of Directors meeting for consideration by the board to award the construction contract. We also have a labor compliance RFP out. The labor compliance RFP will be for the pump station fire hardening, Highland tank, and the Redwood Park and Echo tanks. That closes tomorrow. And so then we'll have a labor compliance consultant helping us out with those. Lion slide repair, we are under contract with VV Land Surveying to give us an updated topographic map for the retaining wall design. Haro Kucinich has provided a proposal for the geotechnical recommendations. Staff has drafted the professional services agreement, and we'll send that out for signatures probably tomorrow. CDU Peavine Supply, we are developing engineering plans for the raw water line. We are going to deliver 60% plans to the environmental consultant on December 12th, which is next Friday. We hope to have 100% engineering plans completed by February so we can start the material procurement. And when it stops raining in May or June, we can be out in the field fusing pipe together, reconstructing the Peavine raw water line. Felton Heights, again, MME is working on the design for that after they're done with the feasibility memo for South Tanks. We already have a feasibility memo completed for Felton Heights tank. The geotechnical investigation is completed and the survey was completed. We do have additional survey we have to do, but we're waiting for the land acquisition to be completed before we spend any more survey time on the parcel. For California 9 bridges, the temporary pipeline is in service right now. That was the first project we did with Corcus this past summer. And so the next part of the project, Caltrans will build half of the new bridge, at which point the district will come out and install the permanent pipeline on the half of the new bridge that's constructed and remove the temporary pipeline. And then Caltrans will come back and build the other half of the bridge. Upper Pasatiempo pipeline, this is kind of related to Charlie Tank. Charlie Tank ring foundation is undermined and is identified in the state sanitary survey as needing work as far as recoding and rehabilitation. Due to the elevation of Charlie Tank, it looks like we will be able to combine zones and eliminate Charlie Tank from the system. So we're going to have to run the hydraulic model to confirm that this is possible. Charlie Tank is a 45,000 gallon tank. Upper Pasatiempo is a 100,000 gallon tank. And then lower Pasatiempo is a 100,000 gallon tank. So, and if it turns out we do need storage, we do have a room at Upper Pasatiempo for 4 poly tanks, which would be 40,000 gallons of supply if it turns out we need additional supply. So the Upper Pasatiempo pipeline leaves the Upper Pasatiempo tank and heads towards Charlie Tank. So they're going to be related when we go in there. And it's possible we just need a PRV installed to cut the pressure. And it'll basically be combined zones. The cloud tank recoating, Quell tank recoating. These are some of the tanks that could be substituted for Blair tank, depending on the outcome of Brookdale tank recoating. And as we consult with operations on what they determine is the best interest of the district, granite, rock, Quell, hollow, quarry, desert pipeline removal. The desert pipeline has been taken out of service now that the Quell Hollow pipeline is in service. A portion of the pipeline passes through the quarry, and the agreement we have with Granite Rock back in, I believe it's the 60s, indicates that when asked, we will remove the pipeline from their quarry so that they can continue mining operations. There's also a portion of the pipeline that passes through a habitat conservation area run by Granite Rock. And so it's possible that we would just leave that portion of the pipeline buried, and we would cap both ends to limit the disturbance to the sensitive habitat. Again, this would be in coordination with Granite Rock and with Jody McGraw to determine what's best for the environment. And those are the Gantt charts that I have available at this time.
So all that's to say,
Not enough.
so all that is to say that we have projects that are here in the
No,
works.
that's great.
We have
Yeah.
$16 million of projects scheduled, and we feel it's time to issue the debt. So to present the board with options on how to do that, we have Mr. Kenneth Deeker here from Del Rio Advisors.
Good evening, Chairman, members of the board. Ken Deeker with Del Rio Advisors. Is this on?
Yes.
Okay. We can bring up the slide now, so no problem. Awesome. Let's go to the next slide. So just I'll start off with a little bit of background here. On February 15th, 2024, the board approved updated rates and charges, Mr. Lillian mentioned earlier. The plan included a financial model that anticipated the issuance in fiscal years 23-24 of debt to fund 19 million of capital projects. On June 6th, the board adopted a resolution to engage professionals to begin process of analyzing the various debt solutions. Bond counsel is Jones Hall. They're not with us tonight. With us from Oppenheimer & Company, I have Nikki Tallman as well. So she's here to answer any questions as we move through this process. Next slide. Obviously, the filing of the voter initiative, the fixed charge limitation ordinance, had the possibility of reducing the proposed debt from the original 19 million down to 12 million. In November of 24, the initiative was defeated. In June of 25, the financing team made a presentation of the board and recommended that staff and the board agree on a 5-year prioritized list of projects. And that's obviously what Mr. Lillian and Garrett went through a little bit ago, just going through the list of projects, the prioritized projects that the engineering committee and I think ultimately the board has reviewed. So what we're trying to do is design a plan of finance that fits into that. In October 25, the engineering committee met, discussed the prioritization of those projects. And then, before we get into a lot of the nitty-gritty details here, I do want to mention that this team is really trying hard to take a global look at not only your existing debt, what's permitted, what's not permitted, but also to look at the entire debt portfolio, including planning for ongoing issuance, because this isn't going to cover the full 55 million of CIP. In addition, what we have tried to do is to maximize the use of cash and minimize the amount of borrowing as much as possible so you can maintain reserve levels at the board policy level, but not generating huge amounts of cash and having to borrow. We'd rather keep the amount of the borrowing down and generate cash use as much cash as possible for the projects. So that's what we set out to do in planning for the various scenarios I'll talk about in just a minute. So I know that one of the questions that keeps coming up is, can the district do a line of credit or some sort of short-term note? So when the district wishes to issue additional obligations on parity with existing obligations, there is a legal provision that must be met known as the additional bonds test. This is calculated as current net revenue with allowances for approved rate increases as compared to the maximum annual debt service on all obligations, including any proposed obligation. This calculation must meet the debt service coverage requirement, the ABT, the additional bonds test, at a 1.25 times. Unfortunately, the bullet maturity of any line of credit or short-term note places a spike in your maximum annual debt service. Maximum annual debt service being the highest year of debt service in your portfolio. You have a $10 million note, that's a $10 million principal payment that causes your debt service to spike, and that means you'll violate the additional bonds test. However, most additional bonds tests contain provisions which allow for an assumed 20 to 30 year amortization of the short-term obligation, allowing the issuer to meet the ABT. This is allowable since these short-term obligations are often taken out or paid off with permanent long-term loans or bonds, which are also amortized over a 20 to 30 year period. The lack of this provision in the district's ABT prohibits the district from entering into any short-term obligation with a bullet maturity. So let's talk a little bit about the sale type, because the district does have outstanding obligations.
I'm sorry, could you go back to that? So the short-term loan with bullet maturity is not allowed.
Correct.
What about a short-term loan with that amortization over some longer period of time? I didn't quite.
I haven't seen that done. If it's out there, we could certainly research that. I don't know, Nikki.
I'm sorry, I misunderstood you then.
Because a short-term note is a short-term note anticipated to be paid off within a 2 or 3 year period, whatever that period of time is. And
I
bullet,
see.
you pay interest only, and the bullet maturity is like in the 3rd year.
I see.
And that's the idea behind a line of credit. You're drawing down the money, so every time you draw down the money, the principal balance that you have to pay off at the end continues to increase, and you'll break through your additional bonds test.
Terrific. Thanks very much.
And unfortunately, like I said, the documents that you currently have do not contemplate that possibility. And that's very common structure for a lot of them. And I think one of the questions that we received, I'm not sure if it was the board or the public, was do we have an example of some of that language? And I've got that some today if you want, if I just like me to share it.
One other question in relation to that is if there was a short-term loan, not of the 10 million you speculated about, but of 2 million, it seems like that would be less likely to trigger the issue that you.
We have to look at what your existing debt service is, your maximum annual debt service versus the net revenues that you have available, including the rate increases that you've approved. So those are allowable. That is a possibility for some small interim financing. But I guess the question I'm asking is, why interim financing? Because at the end of the day, you're paying interest on the interim financing, and you're going to take that out with bonds. If you're going to spend the money right away, why not just do the bond issue?
Because you'd be paying off that bond over 30 years instead of getting rid of that debt in 2 or 3 years.
You have to take out that debt with something else. So you have to take out the debt with some long-term loan or bond, right? So that's the outstanding issue.
Yeah, this is where some additional analysis, though, would be done on the trade-off between short-term and long-term, because we don't spend the 19 million right away. And so we wind up carrying a lot of interest on that unnecessarily. I think that's what Brian was trying to get to.
Yeah, thanks, Bob.
Okay, but you cannot issue a short-term maturity with a bullet. You just can't. I mean, it's not permitted under your legal document. So as much as I do the analysis, there is a minimal amount, maybe $1 million, maybe $2 million. I'm not sure what that dollar amount is that you could do on a short-term loan.
Well,
but let's also keep in mind that in this current interest rate environment, if you're borrowing at 4 to 4.5%, you're also earning interest at close to that same amount in your pool cash portfolio. So you don't have a lot of negative cost of carry. If you were in a really low interest rate environment at 0 or 1%, like we realized for a number of years, you would have a negative cost of carry to that.
And interest rates are dropping. And we also only really need the short-term money for a lot of design work, which is not as expensive as the construction, and which $1 million or $2 million may actually be fine.
But it's my understanding that you are spending reserves to do a lot of that work right now in design and engineering. Is that correct?
Yes.
Well, let's make sure that we aren't being promiscuous in our language. Reserves to me is cash that we can use for any purpose whatsoever. It's not cash that's associated with a loan. And second of all, we also have amounts that we have to set aside per our capital and operating reserve policy to make sure that we have sufficient cash available in case of a disaster. So that gets taken off the table as well.
Great, thanks so much. Sorry for sidetracking you. That's
fine.
helpful.
And I had a question too, if you don't mind. I wasn't following exactly what is it that what provision are we missing that would have allowed? I didn't quite
Yeah, I'll read
understand
you
it.
an example of what could be, and there's a couple places in legal documents where this could show up.
Uh-huh.
One is in the additional bonds test itself, and here's an example of what the language. For purposes of calculating the parity debt service on any balloon obligation, it shall be assumed that the principal of such balloon obligation will be amortized in a manner resulting in approximately equal annual installments of debt service over a term of 30 years. There's also a chance that it could be in the definition of annual debt service, which is part of the legal documents. With respect to any parity debt other than installment payments, having 25% or more of the aggregate principal amount due in any one fiscal year, annual debt service shall be calculated for the fiscal year of determination as if the interest and principal on such parity debt were being paid from the date of incurrence thereof in substantially equal amounts over a period of 20 years. That's pulled from the additional bonds test of two of my clients. Two city clients, one was for a wastewater project and one was for a water project. So it's very common to have these sorts of language either in the definitions in the legal documents or within the additional bonds test.
Okay. Yeah, I guess what you're hearing from us is that we have been asking about maybe a $1 or $2 million line of credit just to have it available if it's not too costly to have it, that could be tapped very quickly and then paid off quickly. And I guess one of my questions would be, how often is the debt service ratio taken? Is that monthly, quarterly,
It's
semi-annually?
measured annually when the audited financials are completed.
So for sake of discussion, if we took out a $1 or $2 million loan in January and paid it off in December, we're presumably fine. If
No, because you got to measure it the day you issue the new obligation.
I'm
So
sorry,
it's the day you issue the obligation, it's measured and then annually measured each year as the annual financials.
okay,
But
but
so
still,
you have to meet the test when you issue the obligation, whether there's
I
entering
see,
into a line of
I
credit
see.
or a note or whatever.
so if we take out $1 million line, we have to
You measure it at that
assume
point.
that it's all out.
That's when the additional bonds test applies, is the date of incurrence of that obligation.
Okay. And so where we have debt coverage in some of your examples of 1.6 or 1.7, taking out that million might reduce it to 1.5 or 1.4, whatever.
Yeah.
That would have to be looked at, I guess. But it sounds like it's possible. And I guess I just want to understand, if it's impossible for some legal reasons, okay, that's one thing. But if it's possible that it could be played with, then
We generally refer to the short-term financing. It would be for $10 or $15 million that you would then take out with the issuance of a long-term bond or a USDA loan or an SRF loan, because you've got some anticipated takeout mechanism for that. If you're going to pay cash to take this off, then you might as well just apply the cash to pay for the project or pay for the engineering design. You do have available resources in your reserves above and beyond what the current policy shows. I guess $11 or $12 million that you're sitting there. Why incur the obligation if you can pay cash for it? And you can get reimbursed from that if you want to the reserves from the bonds. The board did approve a reimbursement resolution. So if and when we do issue bonds down the road, you can get reimbursed for any of those amounts that you wish to recover back into reserves.
Because
So I-
sometimes we may need the additional cash. That's all. It's a flexible option. I don't know why we're arguing about this so much in a negative fashion. I would see it as something that can be very positive as long as we don't violate our covenants.
No problem with that whatsoever. Like I said, it's the larger amounts that create the problem in the additional bonds test. You want to minimize a minimal amount. You will pay costs
Understood.
to that
Right.
financing as well. There will be
Right.
costs involved.
But I think we could be looking at when would we want to be issuing construction contracts? Because from my understanding, that's the trigger for when we need to have that money in place, is when we issue the construction contract. So I'd like to leave that with Jason and Garrett to look at the various projects that you've shown us as to, okay, how long do we have those in design, but then when do we want to issue construction contracts for those various ones? That would then trigger, when do we want to have the major loan package in place?
Yeah, I mean, we have the project for $10 million, a little over $10 million right now, ready to go. I mean, we're getting the 2 tanks. We're gonna be bringing that back to the board for
Okay.
yeah. So we have projects ready to go as we speak.
Okay, I hope so.
Yeah,
Please proceed.
Yeah, yeah.
Go ahead.
yeah. Sorry about the interruption. We'll probably do
No,
this
please,
all.
that's what we're here for. This is an informational workshop. Please ask those kinds of questions.
Appreciate it.
I do
Okay,
appreciate it.
thank you.
So there's a couple of different sale types that we took a look at for selling the obligations, and the district does have both direct placement, or sometimes called private placement debt, and public offer debt. A direct placement is a sale of the obligation to a commercial bank or other institution that invests in municipal debt and will generally hold the obligation for their own account. Most direct placement lenders require no more than a 15-year term, with a few select allowing a 20-year term. That's important. The shorter term has the impact of compressing the amortization and increasing the annual debt service, placing pressure on future debt service coverage and future rate. Also, most direct placement lenders, which is the case with the ones you've entered through in the past, require relatively level debt service, allowing very little structuring or wrapping around your existing debt. And your existing debt is not level. It does vary around. So the interest rates in the direct placement market are higher than the public market, but the cost of issuance are generally lower because we do not need to produce an official statement, which is the underwriter's marketing document, or apply for a bond rating. Public offering is the sale of bonds to primarily retail and institutional investors. That would be people like Benham, Franklin, you name it. The underwriter's right here. There's a ton of firms out there that buy municipal debt. The public offering requires an official statement, which is used as the primary marketing document. It describes in detail the bonds, the district, and the credit. A public offering will allow for the flexibility to structure the COPs around your existing debt service with the goal of overall level debt service. The public offering will also allow for a longer financing term, up to 30 years. Doesn't mean you have to do 30 years, but up to 30 years. And we'll talk a little bit about that in just a minute. This is a list of your existing parity obligations. One of the clarifying things I did on the presentation was to clarify that that was as of June 30, 2025. Those are the balances as of that date. Next slide. So, per the district's 5-year CIP report, there's now $55.3 million in CIP that needs to be funded through fiscal year 30. $25.1 million is in fiscal years 26 and 27. $30.2 million is in fiscal years 28, 29, and 30. In fiscal years 26, 27, the projects are being funded through a combination of grants, fire church surcharge, and one of the questions is, what does PAYGO stand for? It's pay as you go. Basically paying cash from reserves or capital funds to pay for the projects and not borrowing for it. Those sources have currently been identified as $8.6 million and a proposed initial bond series that will net $16.5 million. The reason that we've proposed a single series is because in this market there is very little negative cost of carry. Assuming a conservative borrowing rate of 4.5% and a reinvestment rate of 4%. On the other hand, another bond series will incur additional costs of approximately $400,000 to $500,000 to pay the cost of issuance. So you are earning money on the unspent bond proceeds. It doesn't completely cover the cost. There is a negative cost of carry, but it's a lot less money than paying the additional cost of issuance. So breaking the 16.5 into two $8 million issues is not very efficient. Now, Mr. Foltz is right. We may be in a lowering interest rate environment. I think that's to be seen. If rates go down, there's probably a break-even point there of another couple hundred basis points down where you might have been better off just, doing the second bond issue. But right now, it takes a while, and those are lagging interest rates. Right now, I think Pool Cash is earning close to 4%, just over 4%, something in that neighborhood. So there's not a lot of negative cost of carry. And again, that 4.5% that I've assumed is a conservative interest rate just for purposes of the plan of finance. The proposed funding in fiscal year 20.
Excuse me, just one quick question for Sherry, I think. Are we earning 4% right now on our investments with the county?
A little over 4, isn't it?
What's that?
Wasn't it a little over 4 in the last report?
Yeah, I can get the exact number. It was definitely a little over 4. I want to say 4.02.
Okay, great. Thank you.
It's over 4.
So the proposed funding in fiscal years 28 to 30, according to the plan that we put together here, includes a mix of PAYGO and the assumed issuance of another debt obligation in 2028 to continue to fund the remaining CIP. The amount of the proposed pay-as-you-go and issuance very much depends on how the initial series of bonds are amortized. For purposes of this analysis, we have assumed a single series issued in fiscal year 28. It may get delayed to 29. It may get broken up into multiple pieces. We're just assuming that we've got to find funding, combination of pay-as-you-go dollars as you're generating net revenues and bonds to pay the rest of the CIP.
A quick question,
Yes.
maybe for you or Sherry, is obviously the pay as you go is a pretty important piece of this.
Yes.
And so, given the capital reserves that were just approved or soon to be, okay, but assuming that happens, have you, I guess, just vetted this to make sure that the assumptions that they're making for how much cash is going to be available actually will be available given our reserve? We might be able to tap the capital reserve, but we wouldn't be tapping, obviously,
Yeah. The rest.
the OPEX or the emergency reserves. Has that been done yet, just to make sure?
So I know it was done a couple of months ago, but because we are still working on that reserve policy and there can still be changes to it, it's not included in this for that very reason, but it's something that we can do very easily.
Can I help here a little bit? If you go back to the rate study that was done back in 24, I think the final report was in February 24. The assumptions they had back then was that in 26, 27, fiscal year 26, 27, and 28, we would be receiving a total of $36 million from FEMA. And that was going to be the magic bullet to fund the capital improvement projects that we're talking about here, and perhaps even more. So at some point, we're going to need to look into that as well, because that was a major component of the rates and the rate structure that was set up.
One more quick question while we're on the topic of PAYGO. I envision the capital reserve policy as liberating a tranche of funds that could be used for PAYGO on a one-time basis. And then we will be moving forward through time with some portion of our annual budget yielding some amount of funds that could go towards the PAYGO category for capital improvement projects on an ongoing basis, more or less. Do we have a ballpark number of what that is?
We're going to go over the pro formas here in just a minute, but a lot of that PAYGO information is in the pro formas, the assumptions that we've made. So what we're doing here is the $4 million in your policy for the emergency, that is not being touched. Your reserves drop down to about a 3-month low during that period of time where you're spending all this money on CIP, and you are spending your capital funds for capital projects. That's the idea behind it. And then after that, they begin to reestablish themselves because you're continuing to grow. Your rates continue to grow. You continue to generate net revenue. So we are taking into account the potential reserve policy based on some of the discussions at the last meeting that I was at where you guys were discussing that topic. So we are trying to protect those emergency reserves, protect your operating reserves, but we want to use the cash prudently, which is, yes, we're going to let them come down a little bit, but they'll reestablish themselves over time. And you see that in the profile.
Okay, I'm glad to hear that, because I think in 2030, you were showing for most of your scenarios the low cash point, and it was around 6.5 million.
That's correct.
And you're saying that 6 million is the 4 million of emergency that can't be touched, and then the 4 months of OPEX.
It's about 3 months, I think, if you do the
3
math.
months.
But yes, we're trying to get to that about 50% target. It seems
All
to be
right.
that magic number protecting
Okay.
those dollars.
Okay.
And then beyond that, as you generate additional dollars, you can see the reserves begin to grow up.
Yeah.
We have made certain assumptions I'm sorry, go ahead, Mr. Fox.
Well, I am, of course, the biggest skeptic on this, probably because of the history that I've seen of our budgeting and the accuracy or lack thereof in it over the years. Our operating expenses are growing at well above inflation. The rate study assumptions were bogus. And so when I look at the combination of operating margin and non-operating margin, I see, and assuming that we take this debt out, I see that at most we're going to have about $1 million a year, going down probably to $500,000 or lower a year in money that isn't going to be applied to debt service. So we're really going to need to dive into those numbers, I think, in a really substantive way, and make sure we understand the assumptions that are behind any of the operating expense numbers that are coming up, to make sure that they aren't bogus like the Raftellus numbers were.
Please, go ahead.
I mean, I guess we're just all over the place here, but you're gonna just.
Please proceed.
No problem. And again, I mean, you know, this pro forma was developed between myself and Heather and Nikki and so on, trying to make the most reasonable assumptions that we could. And again, we're just really looking at the first bond issuance tonight. There's a lot of things that have to happen between now. You have to finish your current CIP list. You've got a lot of things going on. You may push out the second bond. There's a lot of things that are going to happen. I do agree that you need to continue to watch operating expenditures and net revenues generated as you go along here. And that's part of the project, right? Every year, look at your debt service coverage, look at your net revenue. So I totally agree with that. Okay, so we talked about a little bit about what the projects are and the assumptions. So let's talk a little bit about the scenarios that we've run here. Next slide. So the ones in green are the ones that I consider to be possibilities for the board to consider, and I've given more detailed schedules for the three. The very first one was a 2026 30-year issue and a 2028 30-year issue, what I call wrap debt service, where I'm wrapping the debt service around the existing obligations. And what I'm looking at is the total portfolio debt service, given your existing obligations and the proposed bonds. Your normalized debt service coverage at the end of the pro forma period is about 1.7 times, so nice healthy coverage. Your ending cash balance is about 88%. The low point gets to that 50%, 49% in 2030, as Mr. Russ mentioned earlier. You are putting in, for the 2028 series, about $16 million of cash into the PAYGO to keep the bond amount as low as possible and still maintaining that about 50% threshold. And the total par amount of bonds issued between the two series is about $31.6 million.
And I'm sorry, remind me what the reference point is for ending cash balance of like 88% or 83.
That's 88. That's your net. That's your ending cash balance as a percentage of operating expenses.
Of operating expenses.
Operating expenses, right? That's the normal measurement that you would use.
Thank you.
Yeah.
So let me just a really quick here on this. You're saying that with our current rate structure and our current assumptions for operating expenses for the next 5 years that Heather had put together, which were quite a bit different from the rate study, you're saying that we can have up to $30 million of debt taken out between now and 2030.
That's correct.
That's,
yep.
Boy,
You got to realize that the Raftellus study did include a minimum of 19 million, and I can't remember. I think it had a follow-on series beyond that too. If I'm not
no,
mistaken.
it did not.
It did not. That's because the FEMA grant was expected. Was that the case?
Well, that's because I was expecting $36 million in FEMA funding.
Got it. Okay.
So that's why I'm a little skeptical about the 2028. We'll get into the numbers, I'm sure, but I don't see it with our current growth and operating expenses being able to do another one in 2028.
Let me ask, I mean, this is probably as good a point as any. If the debt service ratio of 1.25 is checked annually, if we violate that, let's say our operating expenses get out of whack, or we don't have the revenues we expected, and so we're not there, what happens?
Okay, that's a very good question. Okay. So you have made a covenant to bondholders or to the commercial bank, wherever we end up selling the paper to,
right?
That you will set rates and charges sufficient to maintain that coverage requirement. So you are legally bound to raise rates and charges back up to the 1.25. Every one of your legal covenants has a little bit different time period for when that has to happen. Some are say 30 days. Some are say you have to notify the insurer by 60 days. I mean, there's a bunch of different provisions. But immediately you would have to identify and notify the lender or the bondholders through the trustee, and then you would have to start the process to do a 218. And that's usually acceptable, especially to the bond insurers, as long as you're moving towards the adoption of approved rates. to get it back into compliance. So
So
it's not like a disaster, but you do have to take action, and you are kind of tied to a legal covenant to do that. I'm sorry, Mr. Foltz.
So Bob, we have been out of covenant coverage in the past, distant past, like 10 years ago or so. So it's not unheard of. And I don't believe anything was, on the order of a disaster when that happened. There was a rate increase, I think, that went into effect after that, sort of like within a year or so that took care of it.
And I believe that that's the reasonable time frame that most people expect, because we know it takes a long time to go through the rate study and notify the holders and go through the whole thing. It takes a long time. We all know that.
Yeah, I'm not familiar with the 218 process. Is that about a year or half a year?
It's about a year,
About a year.
I think, from start to finish.
It can be as short as 60 to 90 days.
Yeah.
But if you do a full rate study, it usually takes about a year, Bob.
Okay. And so there's no penalties or fees associated with that, with triggering, oh, you're out of compliance.
No, but you have to get back into compliance, or they can begin to take legal action against you.
And they could call the loan if we did nothing, right?
Yeah, they could accelerate the loan, but that doesn't really do the lender much good because there's nothing to pay the loan, right? So I mean, that's
Right.
I understand the acceleration provisions, but so the worst case scenario is you do default and you miss a payment. And on your direct placements, the banks have put in a taxable or a default rate in your loan, so the interest rates would go up on those direct placement obligations. Wouldn't happen on the publicly offered bonds.
I see.
You would be subject to acceleration, but like I said, that doesn't really do much good. There are time periods for you to cure. You would then ultimately have to draw on any reserve funds set aside for the obligation, and then ultimately, if there was a bond insurance policy, you draw on the insurance policy. So there's a whole step of process. I don't like to talk about default, but we've all seen situations where it has occurred. But I think the real action that you would need to take would be to get back to compliance as soon as possible and show good faith to your lenders and to the bondholders that you are taking such actions.
Okay. Yeah. Thank you.
Okay, so I basically, in thinking at this, I'm like, well, okay, I consider that 30-year wrap debt service scenario to sort of be our base case. That's sort of, we can do a 30-year publicly offered bond, but to me, it seems like we're paying a lot of interest. We may not have to. So I took a look at shortening the term of that to 25 years while still wrapping the debt service around. And what you can see here is there's $6.5 million of lower total debt service over the life of the bonds versus the 30-year amortization. We still maintain coverage at a nice level at about 1.58 times. S&P considers A-rated utility someplace in that 1.5% rate or 1.5 times coverage. So that's it's a reasonable, and we're not paying that extra $6.5 million of principal and interest. The low point of cash, again, is at 50%. That's one of our targets. We're trying to make sure we maintain your minimum reserve balances. A little bit lower in PAYGO contribution because we have a little bit less cash because of the slightly shorter amortization. So it's $500,000 less PAYGO that we can contribute. And we're issuing about $32.1 million of bonds because, again, we have less money that we're putting towards PAYGO. To me, and one of the recommendations is that's sort of the optimal scenario. I also took a look at what happens if we do a 20-year publicly offered bonds, wrapping the debt service around the existing obligations. You can see that total portfolio debt service does go down by another $5 million. However, your debt service coverage, because of the suppression of the amortization, drops to 1.37. Ending cash balance drops to 72%. You still reach the low point at 2030 at 50%. But again, because of the shorter amortization, we're limited to less PAYGO that we can put towards projects. Therefore, we're having to borrow more money.
And just for reference, you were saying that at the above 1.5 debt service coverage, that would be rated, you said,
like in the A category.
So what would 1.3 or 1.4 be? Is that, I mean, I'm trying to.
There's a lot of factors that go into a rating, and it's probably a good time to discuss that.
Okay.
So management, stability of management, governance, financials, economic situation, rate base, what's the socioeconomic of the region. There's a lot of factors, and they're all weighted within the S&P rating category. One of them is debt service coverage.
Okay.
And so it is, the lower that gets, the more pressure it might put on the rating, but there's a lot of other factors that are part of that as well.
Okay. And is there any difference in typical rates that would be market rates for 30 years versus 25 years?
Yeah, I mean, your overall borrowing cost will be lower for a slightly shorter amortization.
Okay, because I mean, I ran the number really quickly. For 0.1%, it works out to be $300,000 over the course of a loan.
Yeah.
So it's still big money, right?
Oh, yeah, it's big money. And,
Yeah.
we're talking about quite a few bonds here, but we're also,
Yeah.
I'm being conservative on the interest rates here. I want to be very cautious because we don't know what's going to happen between now and ultimately when you want to sell bonds.
Yeah.
I'd like to think Mr. Foltz is correct that we're in a lowering interest rate environment, and I hope we are. So that hope to take advantage of that. But we've got some cushion in the interest rate there, so these numbers are conservative, but I'm trying to do that on purpose, right? See what we can and cannot afford.
Okay.
So then I took it one step further and I said, well, what if we did 15 years? And you can see that the shortening of that amortization blows us through the rate covenant at 1.12 times. We can only put $11 million towards PAYGO and about almost $37 million in bonds. So you can see the relationship there as you begin to shorten the amortization, looking at your total portfolio. I then said, well, what if we did a 15-year now? What could I do? What would I have to do in 2028 to get back into compliance? And you can see I'd have to do an 18-year public offer deal wrapping the debt service to get back to the 1.25. And that's the minimum coverage requirement.
Yeah. One of the things I thought was clever about the 25-year double set is that your final 2 years, you're basically taking all of the debt, and that's how you're really effectively paying it off. And I guess that's the beauty of a wrap.
That's the beauty of the wrap that you cannot do in the direct placement market.
Right.
Yeah.
Right.
Or the longer term in the direct placement market.
Okay.
But I do know that the district has done a number of direct placements in the past. So I also took a look at what if we did a 20-year direct placement. Again, that market for 20-year direct placements is somewhat minimal. There's only a few lenders that would go out 20 years. A level debt service, and again, a 2028 direct placement. You have lower cost of issuance. And you can see here that your total portfolio debt service, but because of the short amortization and the fact that it's level, no shaping of the debt service blows us through the rate covenant.
And that could be just 1 year in that whole 20 years, right?
1 year in that whole 20 years. And you do have some bullets and drop-offs in your existing portfolio because nobody really took a look at the global picture of this.
Right.
And then I said, okay, well, what if we do a 20-year direct placement and then came back 3 years from now or 2 years from now and did a 20-year wrapped public offering? You do get back to very similar to what the 20-year wrapped debt service looks like, back up to 1.38 times. You have about $95 million. But again, that's a relatively low debt service coverage requirement. And if you're concerned about increases in operating expenditures and so on, that's a pretty minimal margin to work from. Again, $13.5 million in PAYGO. And then the last scenario basically was a 15-year direct placement, 15-year direct placement for both. And you can see that we barely get over 1 times coverage because, again, that really compressed debt service amortization and level. Because, again, it's a direct placement, no wrapping is available. And then I said, what will we have to do to get the 15-year level back? And it's another 18-year wrap to get us back up to barely above the 1.25 times coverage. So looking at basically wrapping the debt service now, maintaining what I believe is a very reasonable normalized debt service coverage, we are recommending the 25-year public offering for this first scenario. And again, we'll have to revisit again in 2028, 2029, whenever you get around to doing your next series. But this gives us a lot of flexibility and buys you some room as you work through all these things. So if that kind of makes sense, I'm here to answer your question.
So
Can I ask
the reason you're putting the 2028 series out there is not that we're being asked to consider that now.
You are not.
Simply for this analysis, how does that factor?
We're planning to try to fund your entire CIP. That's the global look at your entire CIP.
Right.
Now, if you push projects out or things get delayed on project, you may not do bonds until 2029 or 30. That's a possibility.
Yes.
So right now, this is our best guess based upon the CIP that everyone's prioritized here. So we're trying to fund that as best we can.
Right. And at that 16.5 number that the memo that you put in front of a station recommends. Okay.
Mr. Foltz, I think you were going to ask a question.
Yeah, the number in the total portfolio debt service showing right around 100 million. How did you calculate that?
I took all of your existing 5 obligations that you have, and I added in the 2 debt service schedules for the proposed bonds in 26 and 28. So I'm looking at And each of these scenarios has the same debt service schedule for your existing obligations. The only thing that changes is the amount and amortization of the 26 and the amount of the amortization of the 28.
I'm trying to figure out how we get to 100 million.
It's on page 11, Bob. Yeah, page 11 shows
If you look at
the,
page 11, there's the debt service schedule.
right.
Why don't you go to page 11 real quick?
Yeah. And I think it adds up to about 40 million is what we're currently obligated to for total debt service. And yeah, and then there's
Adding another almost 60 million.
adding another 60. Yep.
Oh, no, sorry. Okay.
Yeah.
I wasn't getting what the number was. I was looking at the amount of the principal amount of the loan, not the total of the payments. So,
What I'm trying to do here is to look at what is the total payments that the district has to make over the remaining.
okay, that's fine. But what I'm looking at is how much principal we have to take out, because given our current, given the current cost of our infrastructure and the life of the infrastructure, we need to be spending between 6 and 8 million a year just to stay current, not dealing with any deferred maintenance or deferred capital projects. So when I saw the 100 million, I was like, how the heck did that happen in principle? But I understand now.
And you can see here on the right-hand side of the schedule how that's a level debt service. So we've stabilized what is sort of a rocky debt service between all these obligations. We've levelized that out now.
Yeah, now on the Felton loan, which is going away pretty soon, but that's not covered by rates, right?
That's the assessment, correct?
That is this assessment through property taxes, through the people that own property in Felton. It has absolutely nothing to do with our rates. Zero.
Now, I think this was taken over from Callahan, isn't it?
Yeah.
And I believe it was listed in your 2019 official statement as a parity obligation. So we have to continue to show that. But I can certainly explore that. That's fine. It's a minimal amount of money at the end of the day. And compared to
Yeah. I mean, it is now. It didn't used to be, but it is now.
Yeah.
Yeah, but that is funded by property taxes, not by rates. And only in Felton. Okay, great, thanks.
A question about the one thing that I'm just some of the terminology. So there's level, the term level is used, and the term wrapped is used.
Right.
And I'm looking at the chart. Maybe this is about to come up, but
So if you look here at what the debt service for the 26 POPs, I'm shaping it around your existing obligations. So you're paying very little principal during these periods of time, and I'm shaping it around. If you go to the
and that's it. The purpose of that is to flatten the top of
is to flatten that out to make it a consistent level debt service over the remaining term of your obligations.
And is that wrapping the loan around the other loans?
That is correct.
I see.
We're shaping it around, adding principal
And
in years where principal is lower. That's correct. That's why that graph looks relatively flat at the top. That's your total debt service line at the top.
Okay. So one of the things, and maybe this is just me being silly, but the chart is very level at the top. But that's not, when you guys are talking about level, that's not what you're talking about.
Yeah, so these are basically each of the obligations here, and this top line here is the total of all your obligations. So you're paying about 3 point, whatever that dollar amount was in the previous chart,
3.8 or
3.6 million a year. You can see that's the total payments. It's like layered on top of each other, but at the end of the day, you're paying level debt service once you get to that 2028.
And that avoids those spikes.
That avoids
get into
those spikes.
withdrawal. Yeah.
It is a little more expensive to sort of shape this around at the end of the day, but we'll have much lower debt service coverage if we have to amortize level, which means principal and interest payments are level for the obligation. A direct placement, the principal and interest payments, like a mortgage, has to be the same every year.
I see.
There's no ability to shape the debt.
And the level would be more like a wedding cake where you could have this real
Right, and you'd end up with a structure that looks pretty front loaded here and then drops off over time. The problem is this is where you run up against your rate covenant because of that. And that wasn't really taken into account when the previous transactions were done.
Gotcha.
Okay. And
we're trying to clean that up and shape it.
And on this slide here, I see that we're back to making assumptions about operating expenses growing at only about 4 to 4.5%. That's nowhere near our historical experience. So this is where I get extremely skeptical, because this is now starting to get into Raftellus type numbers, which just don't match what our historical averages have been. And
Well,
that
and
has a dramatic effect on the money that's gonna, I just don't believe this net revenue available. Sorry, guys. These numbers will not come to pass. This is fantasy.
I was going to ask if a sensitivity analysis has been done. In other words, when you sort of hit net revenue or hit gross revenues or you hit expenses and go up or down by 1 or 2%, how does that impact the expense
We can
ratio?
certainly do that. That's not, it's a spreadsheet. I mean, it's.
Yeah,
it's
it is
something
exactly,
yeah.
but it gives us kind of a feel for how sensitive is this? How easy is it to hit that?
I think where
you know?
this is really going to start to impact, because a lot of these numbers, these assumptions are all from Heather when we were working on the pro forma. This goes back about a year ago, probably maybe more than 18 months ago.
Right.
So through 28 is reflected the existing rate increases. And then beyond that, we've just assumed the rate of inflation that would require a new 218 to go through at like approximately 2.9%, basically the rate of inflation.
I get that, but I mean, I just don't remember these kinds of numbers, and the most recent numbers that Heather was giving us as we were going through the discussions around the employee contracts and the like. I didn't see us getting a net operating margin of anywhere close to 5 million. It was more like 3 going down to 2.
I do recall that Heather had assumed that I think salaries would go up a maximum of 5% per year. I think that's
Yeah, but that's again,
that is consistent at 5%. I think the general operating expenditures.
that's not been our history.
Well, and that's the question. Yeah.
I mean, this is the thing. This is one of the reasons, one of the fundamental issues I had with the whole rate study process anyway, is that we took a model that a consultant provided us who didn't look at our history and just sort of applied sort of general inflation numbers, which they didn't look at employee contracts, any history, anything like that. And so it skews things a lot. One of the things that we might want to consider doing here, in light of this work that Del Rio's doing, which is very good work, and I don't have any issues with the basis of it, but going back and saying, do we want to look at taking that model on the rate structure now that we're getting very close to having the employee contracts done, we hope, and looking at what the rates really need to be in order for us to meet 55 million in CIP.
I think we should be going back and looking at that because you're referring to what Heather had provided us a year and a half ago. That's history at this point. So yes, I think we should be going back and looking at that.
And I would also advise us doing that, given that our current rate structure is illegal, as having been determined so by the Pats versus San Diego case. That said that all tiered rates have to be quantifiably justified, and we did not do that.
We can go back, and I think we should be going back and looking at that. So yeah.
But I will say, this isn't going to really impact the first bond series if you need the capital. I mean, we could spend months going through this entire process. If you need the money now, the first series of bonds could be issued. This is really going to impact the second series.
I don't think it's a lengthy thing to do in order to sort of take the model before and put in the real numbers. It's probably a 30 to 45 day thing at most, and can be done in parallel with the work that you're doing.
I'd like Jason and Cherie to look at what it would take rather than one of us saying, here's how. So go back and take a look at that and see how that could be factored in and how long it would take you to go back and look at that again.
I also just want to say, I think this is really informative. There's a lot, you put in a lot of work here and a lot of thought. I think we're greatly appreciative of that. But obviously we have to be comfortable with it. And, you know, one of the things that struck me, just so it's said, is that with this kind of structure, basically the 2026 series is an interest-only loan for the first 15 years because no principal is paid off.
And I have to go back and look. There may be a little bit of principal, but you're right. The majority of it has to
it's $100. I mean, it's and so what's interesting about that is that it allows this levelized wraparound to occur, but just from a psychological point of view, it has the impact of, wow, I still owe 17, because really the number is 17 million.
Yeah.
I still owe $17 million.
Right.
And I still owe 17 million after 15 years. And then I start really whittling away at it, right?
Absolutely.
And so that's
the impact of not doing it is putting a lot of pressure on your debt service coverage and rates because of the early years. So there's that trade-off, right?
Or not doing projects.
Or not doing projects.
right.
Yes.
And yeah, and
Right. Or
we've
not
got
doing
these
projects.
priorities. Yeah. And that's the trade-off is which projects for what money do we have and we're comfortable borrowing for, right?
And I do want to say, I really appreciate the committee taking the time. That was one of the recommendations that we made at an early meeting last spring sometime was, let's go figure out what your CIP is and then come back to us. And once we do that, we'll try to figure out how to finance it, right? How to pay for it. Right. And what I've also tried to do is to maximize the amount of PAYGO as I can to the extent. And I think what would happen here, especially on the second series of bonds, if you do not realize the same OPEX, you won't be able to put as much money in. You may not be able to borrow as much money. So that's really going to be the impact of whatever analysis comes out of your discussion. So,
okay. And I did want to clarify where you have like a 14 or $15 million PAYGO number. Is that the net free cash that's available over the 3 years or what?
No, that's coming out each year. So you can see we go from about 12 million down to 8 million and generating some net revenues here. So we're taking.
Oh, I'm sorry. It was on the comparison page.
Oh, the comparison page.
Yeah, sorry. Yeah.
No problem. Take it back there.
Yeah.
Get the main pages here in front of me.
Page 9.
Yeah. I'm sorry, now what was it?
So the
Can I
PAYGO
inter-
contributions, 15.5 million, 14 million in the green there. Over what period of time is that money that's been freed up and that we can spend?
So in the pro forma, we go back up to the next page, go and
Okay.
so in each of the pro formas, what I did is I tried to use as much cash as available to get to no less than the 50% threshold here, which maintains your emergency. That was my bogey that I was shooting for, and spending cash from reserves essentially to pay down the project each year. How much can I do? I just chose, 11 million in the first 2 years, and 4.5 gets us down to about that 50% threshold, and it begins to grow after that. So that was the target. I'm trying to forget the word I'm looking for. The bogey, target, whatever that I'm shooting for.
Can I interject something here?
Yes.
Okay.
So I'm looking at the most recent or the last thing that Heather sent to me on her projections. This is projected through 27, 28. And this is assuming flat consumption, right? So, and really minimal increases in number of customers because historically we haven't had a lot. And her operating margin was 2.5 million. 2.6, sorry. So that is substantially different than what we're looking at here.
Well, I will tell you that with the help of Heather and Cherie, we did update the 25 numbers based on your year-end for 25.
Yeah. So anyway, this is where the numbers, we got to look at these numbers in a lot more, at least I need to look in a lot more detail to be able to make sure I understand and believe what's happening here, given what we've been told in the past, which is, we're looking at somewhere between $2 and $3 million of operating margin available. Not fine.
Yeah, okay. But we've already said, Bob, that we want Cherie, Jason to go back and look at that. And reflect into this then. All that changes this.
Well, and make sure we are, doing an apples and apples comparison on assumptions and the like, right?
Yes.
I can forward to Jason and Sherry if they need it. It was from October of 2024, the last one that Heather sent out to me before she left.
Bob, if you wouldn't mind forwarding that to me as well. Thank you.
Well, I can forward it to
Jason,
and then he would forward it on. Yeah, I can do that right now.
Okay.
A related question, if I could.
Absolutely.
Thanks. I'm curious about the PAYGO transfer from operating cash being its variation over time. The reason I'm curious about this is because my preference when I buy stuff is to pay go first and only take out debt if I need to later. And here it looks like we would go through 2 years of not so much pay go, then a whole bunch of pay go later. And it would seem to me that if we have some $10–15 million available for pay-go, why wouldn't we just push our pay-go expenditures forward and go as many years as we can on pay-go, and then only take out.
The only issue is whether or not you can execute a contract without having the full amount of funding available for the contract. So if you don't have enough to pay for the $10 million project, because you don't have 10 million of cash laying around, and you haven't done bonds, then you can't probably execute the. That's a legal question for the White Brenner folks. But that's kind of where I'm probably coming from. There is, I agree with you. I mean, it makes sense to spend the cash if you have it available, but you're just now establishing your reserve policies, and I do agree that it makes sense to spend cash first. But keep in mind, you can't execute a contract unless you've got the funding available.
Understood.
Most likely.
That's great. Thank you. I will just note, however, most of our projects are small projects. We tend to not have $10 million projects. We've got a raft of $1 million to $3 million projects, if I understand correctly. So, and I don't know how that affects things. Of course, we wouldn't want to pledge the same dollar to multiple projects, but things may be more incremental than needing $10 million in cash all at once.
These first few years right here in 26 and 27, what was shared with the committee as far as the CIP, these are fire surcharge dollars and stuff that are coming in from existing sources. Those are already programmed in to pay for the first 2 years of CIP. These are just assumptions that I made for the second series of bonds. So this is already programmed. You have that cash and you are programming it in to spend on those projects in the first 2 years.
Will we have the 5.5 million in out years? Like, is there a revenue source?
Yeah, I mean, it's coming from ending cash balance. So your ending cash balance is being generated from your net revenues each year, and then I'm withdrawing those dollars to pay towards the projects.
Gotcha. Yeah, thank you.
And then what's the reason for the deposit of bond proceeds? You've divided it into two pieces, the 6.5 million and then 10 million?
Yeah, I was just applying it in the years in which the projects are scheduled to be paid.
Okay.
Basically, I could have put it in 26 or 26. I could have put 16.5 million. You'd have seen a slight positive value. I was just programming it in the years in which we intend to spend the money.
Gotcha. It's not like we had to wait for the 10 million.
No. It all comes in at closing and it gets deposited and you draw it down to this paid project costs. That's correct.
And what would be the timing of, let's say, we spend some more time with Sherry and sync up the new reserve policy, look at Heather's stuff, and just kind of sanitize the whole thing. And what would be the amount of time that we would be required to? Can you walk us through the process?
About 120 days. So about 4 months.
4 months.
And part of that time is to prepare the official statement. If you guys decide to do the 25-year public offering scenario, for example, that requires an official statement. We already have a draft of that because we actually brought the original bond issue to this board a year and a half ago, prior to the whole initiative action and all that stuff. Mm-hmm. And then we have to go through the legal documents being prepared that would come to the board for approval. Because all we're asking for tonight is just approval to move forward on starting the bond document process. You're not approving any bonds tonight. You're not approving anything for 2028. Then we have to go to the rating agency and get a rating. So they'll look at everything from all the metrics for the district, right? Okay. Size, flow, I mean, everything. They look at everything.
That's a $25,000 fee.
That's about 25 grand, give or take. And then we would come back and print the official statement. Once the board's approved it, with the rating and everything, we would apply for bond insurance because depending on where the district's rating falls, if you fall into the A to A+ category, there's a benefit of purchasing bond insurance, which would raise the rating to AA, which is what happened in your 2019 COPs, is you just had an insured rating of AA and did not have an underlying rating. So currently the district does not have an S&P rating. It was simply sold as an insured transaction. That was more common 5 years ago. Now investors want an underlying rating. They want the report about all the district's operations and governance and all that stuff.
Gotcha. Okay.
And then we would set a time to sell the bonds, and the day of pricing, and then 2 weeks later we close. So that whole process takes about 120 days, maybe slightly faster because we have some of the work already done from our previous account. So,
Thank you.
all right, I'll just wrap up here. Not a whole lot more to go. You guys have kind of all gone through the pro formas and
We have.
shaping and all that stuff. So let's skip forward a couple slides here. Keep going. Just get through these. Okay, so here's the look back one. Yeah, okay. So basically, here's the findings. The 30-year wrap debt service scenario provides the highest normalized debt service coverage, a nice cash balance at the end of the pro forma period, but 6.48 million does not appear necessary. The extra debt service for amortizing the bonds over 30 years doesn't appear necessary to us when the 25-year wrap scenario that we've discussed as our proposed option makes the most sense. 25-year wrap debt provides a lower overall debt service by 6.48 million, slightly lower debt service coverage, but again, still above that 1.5 times threshold. A nice ending cash balance at 83%. But this does provide you some room at the 1.58 coverage and with that cash balance for increases in future CIP costs, which is a risk that's out there as well. Reductions in revenue during drought or emergencies or unforeseen increases in operational expenses, like Mr. Foltz was saying. So again, having that little higher debt service coverage, a little longer amortization buys you guys time and some room for things to change as we move forward. 20-year wrap debt service gets a pretty narrow debt service coverage, so we can't really recommend that because again, as Mr. Foltz is explaining, he feels like this is razor's edge as it is, so going even lower than the 158 would be, I think, problematic. Next slide. The 20-year direct placement options really do not work because of the level debt service and the compressed amortization, and none of the 15-year public offering or direct placement scenarios, again, because of the compressed amortization. That was the point I was trying to make in all of this analysis, and I apologize for sort of the last minute change here, but this has been a big moving target. There's a lot of variables, and we're trying to hone it down into something that we thought was explainable and could conceptualize. So I hope we got that across to you guys. Next slide. So we do recommend the 25-year public offering wrap, again, for the reasons that we discussed. We are recommending that the financing team begin preparation of documents. And again, we're not asking you to vote on any resolution. We're just seeking guidance from the board to go ahead and get started to prepare the documents, including the official statement, the legals, and bring that back to a future meeting for approval. If we start this month or early next month, we're probably looking at a March meeting and an April bond closing, so you could have the money by April or May. It's kind of the reasonable time frame to do this. So with that, I'm happy to answer any questions.
So there was an item that came up that I'm not quite familiar with, but if I recall correctly, the intention of the bond is that it be, or the issuance is that the funds be spent in a term of 3 years.
Correct. So the tax rule is 85% of the proceeds must be spent within 3 years and 100% by 5 years.
Got it. And so I'll just reiterate what I believe I've said before, which is that in my experience with design, permitting, construction projects, unforeseen delays are routine. And I appreciate all the analysis gone into the Gantt charts and forecasting of when projects will be shovel ready. I saw the tally of projects. I saw that some of them were not through design, some of them were not through permitting. And what I don't know is the accumulated shovel ready dollar amount of the ones that are ready for construction. And how the pipeline is going to be filling that column of shovel ready for construction over the next year or so that it would take to secure the funds. And I'd like to have greater clarity and confidence about the dollar amount of that pipeline so that we're not getting overextended.
Wait, so that we're not getting overextended.
So we're not borrowing more money than we
Okay.
can execute on.
Right.
Overextended by borrowing in excess of the.
And I view
pipeline.
overextended the other direction. We're not,
Pledging more projects than we.
yeah, we're not pledging more,
Thank you.
but that we're not taking out more of a loan than what we need in particular for the 26 time period.
Correct.
Right.
Yes, that's
okay.
my concern.
From my perspective on that, because I've asked the same thing. I think that our engineering department has a number of projects that they are completing design on now this month. In particular, the two tanks that are ready to bid, but do we have the money to bid those out now?
We're currently spending reserves. So the first slide,
to do the designs.
the first slide that Jason showed,
Right.
what was it, 1.8 million?
$8 million.
Right.
So we've already spent 1.8 million. So we put $1 million into a PO for Porcus to do the Highland tank. Once I have Redwood Park Echo, I'm hoping that we get around 3.1 million. We've budgeted 4.6 million in the approved budget. So if the bids come in at 4 million, we can still go. If they come in at 4.5 million, you know, we might have to reallocate some money to that because we have to pay for the labor compliance. We have to pay for district staff time. We have to pay for, there's other costs besides just the construction costs that have to be accounted for in the budget.
And we're in the final parts of getting P-Vine ready to go.
Right.
That's $4 million.
So I guess what would help me is just a clear table of those projects that tallies. And I believe you shared something along those lines, but the left column of that is showing their status. Not all of them were in that shovel-ready category, and it was hard for me to translate in my mind between the description of their status and the Gantt chart and envision the lag between their current status and shovel-ready. And
Can you bring that back up?
Yeah. Just to add to that, because I had the same kind of question. If you, I have not gotten, and I know it's available, I just haven't gotten both the Gantt charts that Garrett has put together and the CIP descriptions. But to Brian's point, it would be great as part of that Gantt chart, you know, if something takes 3 months to do, as maybe underneath that, you say, and this is a $500,000 project, so we need that money, you know, at the beginning or something like that. So that's, you know, the constraint on it. Because then when you have all the Gantt charts together, you can just see, all right, how much money is needed every month over the next 3 years, you know, whatever that is.
We're working on combining the Gantt chart with engineering and environmental so you can see the whole project timeline.
That'd be
But
great.
to Brian's point,
Yeah.
and what Garrett was saying, we have $1.8 million of the debt financing that includes Bracken Bray and Highland Tank. Bracken Bray and Forest Springs is wrapping up. We've spent the money already.
Yeah, so if we got the debt issuance, we basically pay back our reserve.
San Lorenzo Way Bridge at the $1.5 million, basing on we're ready to go when Caltrans is going to start.
So that one is with the county, and the county's directed us to have the temporary line up by March of 2026. So we won't even have the debt issued if we say we went forward today. We won't have the money in hand, it sounds like, until April. And then the other part is when the county starts building the new bridge, it's possible that their contractor will have a bid item to just install the permanent pipeline inside the concrete box girder. And we would just pay Gordon Ball for that bid item for the permanent pipeline. Similar to what we did in Scott Valley for the when they did their paving project, they had a bid line item for raising our valve lids for the tune of like $12,000.
So,
And this is where a line of credit for 1 or 2 million might come in really handy.
Or we can just spend it from the reserves.
I don't know. Yeah.
Right? I mean, we have
If we have the
12 million,
funds.
right?
Yeah.
In reserve.
Yeah.
We could just spend that down and then take out a loan and take out 60 million, just put 12 million back. And then we have only 4 million left.
In the covenants and conditions for the public offering, what are the requirements for how the money's spent?
So
On projects.
so first of all, it has to be for capital projects. He's absolutely correct. But secondly, you can be very flexible. It can be any projects related to the water system. I think some of the previous, particularly the direct placement documents, the banks may have put restrictions on what the money could be spent on, a very detailed, limited list. With the public offering scenario, you list the projects, you expect it, but it can also be any other project in the water system.
Okay, so we're not tied
Not tied to
to
any
that.
particular project, that's correct.
Okay.
So,
Oh, okay. Go ahead, Bob.
just a little history on the previous projects. The reason that there was project specified was also to provide assurance to the community that things weren't going to get shuffled around as had happened in the past prior to that, where people were told they were going to get projects done and then something else slipped in. So it's important that we give the community some certainty around things. I don't think we have those same conditions anymore, but that was the reason at the time. On the Brackenbury Forest Springs Consolidation Phase 1, that's not including any construction in Brackenbury, correct? That's just for the work on West Park.
Right. Yeah.
Yeah, so the Forest Springs Brackenbury consolidation was a grant that the district received.
No, I don't need more of the background. I just wanted to make sure that 1.8 million, it wasn't the
It's not
construction going
going.
on in Brackenbury.
No.
Okay. I had some additional concerns that I wanted to talk about in terms of the amortization schedule. So,
Bob, could I just ask a follow-up on this table that's up on the screen?
yeah, sure. Yeah.
Thanks so much. I appreciate that. So, debt financing, this column here, titled debt financing, is that the debt issuance that we're
Yes.
describing today?
So you can see in the second section of these are projects that are ready to go in the upcoming year. So we have the bridge, the county bridge, the Harmon Street, the 2 tanks, and the Lion Slide repair are going to be ready to go either early next year or summer of next year, and all of those combined are $9 million.
And then there's the 1.7
From
above.
those are active right now.
And so those active ones right now, do they require this debt service to be completed?
That was part of the budget. And they're completed. We're taking it out of reserve, but
I see.
yeah.
So that's for replenishment. Okay. Thank you.
And if I could also, before Mr. Fultz comes in and asks this question, I just wanted to clarify too. In your reimbursement resolution that allows you to reimburse for, you don't have to do a reimbursement for design and engineering, those are permitted as soft costs, but any hard cost spent, you have a $6.5 million cap. So if you're spending $1.8 million now and you're going to be reimbursed with tax exempt proceeds, that's eating into that $6.5 million cap on the reimbursement. I just want to make that point clear.
Good point.
Okay.
Yeah.
Okay.
Thanks very much, Bob.
So,
Yeah,
Bob,
and in the past, the projects weren't contemplated for reimbursement. They were all contemplated going forward. So additional flexibility would help. On the amortization schedule, with it all being backloaded the way it is, I'm concerned because again, the district needs to be taking out somewhere between 30 and $40 million of loans every 5 years in order to stay current with its capital, requirements. What's the implication for the loans after 2030, 2035, what have you, if we're backloading everything?
So you wouldn't have to backload those because at the end of the day, with these 2 series of bonds contemplated, you end up with level debt service. So you just layer another debt service on top of that. And it would maybe go for 3 or 4 years beyond the term of the existing debt service. It could be level. You've got a lot more flexibility because we're structuring an overall level debt service portfolio.
Well, yeah, but what I don't want to get into is where we're forced into doing interest only for the first 10 years or so on all the loans we take out from now on.
That would not be the case because again, after this shaping of the debt service, you're going to end up with level debt service. So you can layer in a level debt service for your next series and level debt service for your next series after that. It does not contemplate you having to shape beyond these 2 series. I'm just trying to get the debt service portfolio to level so it makes it easier for you to amortize future bonds beyond this plan.
Although the reality is that because
I'm
we're,
not seeing that.
well, at the 3.8 or whatever number that you kind of leveled it at, right, per year, 3.6. But I think the reality is that that's already, 1.5-ish debt service coverage. And so there's probably not a lot of room to have yet another wrap over that. And so maybe to Bob's question,
Not until, I mean, it would require.
No, you would do another rate increase probably given, I mean, this all gets down to
Exactly.
how much
That's what it
money
would
you're,
be.
you're
Yeah.
spending on operating expenses, but you know, you would do another rate increase at the end of 2029, 2030.
yeah, 2029, 2030.
Yeah.
Right. So we
Which,
wanted to
by the
add-
way, you're not required to wait. I mean, this is the other thing, is you're not required to wait that long if in fact there's a justification for it, that you need the money sooner. You can do rate increases whenever you want, under Prop 218. So, and the level to which you do the analysis is kind of based on how far along you are in that process versus, you know, how much you want to redo the analysis. So,
I'm sorry.
yeah, don't feel yourself constrained in that way, particularly given that, you know, at this point in time, our tiered rates are illegal.
So,
But I think one of the questions, Mr. Russ, that you posed earlier was, Mr. Fultz was just referring to it. I'm drawing a blank now. I'm getting a little tired.
about the level service and adding to it, or
No, the rate increases. So
Ah.
the Prop 218 allows you to do 5 years of rate increases, but not beyond that. So I think one of the questions that you had is, how'd you come up with the 2.9? I just assumed a rate of inflation beyond the existing approved rates. But Mr. Fultz is correct. You could do a rate study before that and raise rates sooner, particularly if your CIP costs go up or you need to borrow additional money. That's the sort of thing that you would do. I just made the assumption of 2.9% for now, but it is a 5-year window. Beyond that, you can't do new rates without a 2.8.
gotcha. Okay.
Yeah.
are you good, Bob? Does it get to?
Well, I mean, you know, I think what I'll probably do is if I can get the sheet with the amortization schedule on it, I want to take a look at what the next round of borrowing would be, just to make sure that it's that I have it in my mind through the numbers, that we aren't backing ourselves into any kind of a corner.
I think my question was, do you have any further questions at this point? Because I wanted to transition to the public to see if there are any other questions there before we come back to the board.
Well, the question would be if we can get all of the documents.
I had just a series of really quick questions on your estimated cost of issuance.
Yes.
If you wouldn't mind, that's page 22.
Yes.
Could you just walk through here very fast and just, for the smaller numbers, you know, 1,000, 2,000, not worried about it, but could you just outline what the role of each of these entities is and which is kind of a fixed cost versus a variable cost?
Absolutely. That's a fair
Okay.
question.
All right.
So, and that's the reason I put that reference slide there. So it would be available in case you ask the question. So bond counsel is your legal counsel. They provide the tax exempt opinion on the bonds, and their fee is generally a fixed fee. Disclosure counsel is also the same firm, and they prepare the official statement if we're doing an official statement versus a direct placement. They do the official statement. Cherie's going to have to help a lot with the official statement. A lot of data has to go into that. That's a fixed cost. My fee is a fixed cost based on the schedule that you guys saw when you approved my new contract last week or 2 weeks ago. S&P is an estimated fee. They base it on their principal amount of the bond. So that might go up a little bit up or down, but it's generally a fixed fee. The underwriter's discount is a percentage of the bonds. That's how underwriters are compensated. So that is a variable fee.
Yep.
And then the bond insurance is an estimate right now, but it is based on a percentage of total principal and interest. For the bond insurance premium and the reserve fund surety is a percentage of the reserve fund requirement for the bond. So it might be 1 year of debt service to be set aside as a reserve fund for the bonds. They would charge like 4% of that amount would be their surety bond premium.
Gotcha.
So that varies based upon the size of the issue, the amount of debt service, and so on. So those are variable costs, and then the rest are just minimal fixed costs that we have. Does that help?
Yeah, because I was just trying to understand one of your very first slides about, you know, doing 2 tranches versus 1
Right.
issuance, and you know what would be the fixed versus the variable.
Yeah, most of this would be a similar range of costs, even for a $10 million or $8 million issue. They'll go down a little bit because it's a smaller principal amount, but not hugely so. So I said that range is probably $400 to $500.
Okay, thank you.
Okay. But I do want to come back to your question, Director Fultz, with we wanted to get what the underlying information that this is based on. And I didn't hear. Yes. There is some question at least on Jason's face. Bob, could you ask that again?
Well, yeah, the spreadsheets that underlie the what we've been presented here would be very, very helpful, particularly the pro forma P&L and the amortization table.
The one that's in the presentation?
Well, again, because I'm not there and I haven't
Okay.
gone to the
Yeah, I'll
website, I
I'll
don't
forward it to you
have
right
it.
now.
But yes.
Likewise, yeah.
You're all getting it.
Okay. Okay.
Yeah.
Well, then I think the board, at least for right now, is good with questions. I do want to see from the public. Do we have any questions on this?
I've got several questions. I'm Bruce Holloway from Boulder Creek. I don't know if I'm gonna remember all my questions though. So I want to start with page 8. It says, the plan is 25.1 million for fiscal years 26 and 27. So the thing to me is fiscal year 27 ends in about 18 months. Fiscal year 27 ends on June 30th, 2027. That's
20.
about 18 months from now.
20.
No, that's correct.
So next year's 2026, it's almost here. So these 2 years, these 2 fiscal years we're talking about end in 18 months. And so I just find it really hard to believe that 25.1 million is going to happen by June 30th. One of the things that I've observed when we've talked about this in the past is that the financial types are always on a fiscal year, but the construction season really is more like a calendar year. So if the expectation is 25.1 million is going to happen by June 30th, 2027, I'm totally skeptical. But if it was November 30th, then I might believe it. So that's one observation that I have here. And I see my lights, oh gosh, I don't know what's going on here. I tried to comprehend about the ABT, and I don't get it really, but I guess there's 5 obligations and they all have some kind of a contract, some kind of an agreement. And so presumably if I looked at all 5 of them, I'm going to find this ABT in there, and the only one that doesn't have the provision that we would like to have is this 2019 one, I guess. And so presumably somebody could show me the 2021 one, the CoBank one, and show me where there is this provision in that one, and it's missing in the 2019 one. So I guess I'm still confused about the ABT, but it is what it is. It sounds like it's one of those things that it is what it is. We've got this 2019 contract, we're stuck with it, and it doesn't have this provision, which might make things more flexible. I guess that's the end of the story, but I still don't understand it. And there's 2 pages at the end of the presentation here, apparently taken out of the 2019 contract, but I don't quite see how I didn't understand what they said, and apparently it's a missing provision. So if I looked on those 2 pages, I'm not going to see it because that's what's missing. What I'd rather see is one of the other ones that does have it, so I can see what does it look like when it's not missing. The one thing I want to say to Director Fultz about that Felton loan, it is a safe drinking water loan that we inherited from Callahan. The Felton Community Facilities District number 1 that they're paying, that's with the county. So the county manages that totally.
Thanks for the clarification.
Okay. So when I looked at the amortization schedule, I mean, I guess I'm not happy that it's so back-ended loaded. I'm not that sophisticated. I've never gotten into that kind of a mortgage of a loan. All the other loans you can see on page 11, all the other loans are level, have conventional amortization. And I guess I'm really way more used to that. So I would at least, before this is all done, I would at least like to see what does a 30-year conventional or amortization look like for 16.5 million? And what is a 25-year? Those 2, I'd like to see those. What is a 30 and a 25-year with conventional amortization? Because this is back-end loaded. Another observation I'd make about that, if you look at the graph on the bottom of page 12 with these other loans that we've already got, the blue and the yellow are at pretty good interest rates. You know, one is 2 point something and one is 3 point something. So those are at pretty good interest rates. And these new loans are at 4.5. So we're doing back end loaded with the highest interest rate on this picture. And that doesn't seem good to me. I'd rather bite the bullet and have conventional amortization, bite the bullet and pay a level amount. That picture's gonna look different. So I'd at least like to know what that would look like. It's not one of the 9 options here.
Okay.
Thanks.
Thanks, Bruce.
Thanks, Bruce.
Anybody else from the public online? Question? Right. If not, we'll come back to the board. You've got a question, Bob?
Yeah, I'll echo what Bruce said about the amortization, but my other question was maybe a basic one that I just completely missed, which is, how come we're not doing 19 again?
19 million.
Yeah,
Yeah,
the current
19 million.
the current CIP that we're projecting is 16.5, Bob.
Okay, but I mean, my experience over, as limited as is that in most cases the bids come in higher than the estimates. And
Two different. You got one guy saying that we're worried about not spending enough, and then now you're telling me that we're not taking out enough of a loan.
well, I mean, if 19 million was what was programmed in there to begin with and what we were talking about, why don't we do that? Because what I think might be worse getting into is if we have this 16 or 17 million dollar of capital improvements that we commit to the community we're going to do, and then the bids start coming in at 15-20% more than we estimated, and now we can't do it.
We give the best estimate that we can.
I mean, is adding the 3 million? I mean, the rule of thumb I use is each 15 million you borrow is roughly about $1 million to $1.2 million on a level amortization and payback a year. So is adding another 3 million going to really break us?
Does the rate structure support that? And does it allow us
Because
to?
the rates,
Raftellus would say it does.
yeah, well, the rate
Well-
structure supported the 19 million for sure, because
Right.
that was what was programmed in the rate structure. And you haven't done bonds for the last couple of years, which was anticipated. So you've generated additional cash resources. 2 more years of rate increases have taken place before you issued the debt. You can do the 19 million. It will reduce your debt service coverage.
That's
The sum down from the
one point.
1.58, maybe down to 1.5. I don't know. I don't do the math that quickly in my head. But there would be some reduction in debt service coverage because you're increasing the bond amount. So, but yes, you could do it, and it was already programmed into the rate study, and it can be supported. Where you're going to really start running up against some of these issues is if you plan to do the second series, and the timing of that is when you're going to start really running into how much you're going to have to raise future rates to support the rest of your CIP. And it's really the next 5-year period that's going to happen.
Well, and I think we're going to get a better handle of that by analyzing the numbers we have now. But I'm concerned about cutting it too close based on our history.
Well, it's the old adage, if you can get the cash or get the loan, you take it, grab it. So it's maybe worth thinking about.
Right. And I was under the impression that we were limiting ourselves to the 16.5 projects because that's what we could now support.
Correct.
Given current rates. But it was not how much construction do we want to do? Okay, let's get a loan for that. It was more how much loan can we get? Okay, which projects can we do for that?
These are the projects that are to Brian's point, shovel ready right now with
Right.
$16.5 million, and that's why we ran these numbers to make sure that we could spend that money in the next 3 years.
Well, I was just going to say, I mean, really, let's just for sake of discussion say we get the bond proceeds by the middle of next year. That is the end. That's fiscal year 2026.
Or the beginning of 27, yes.
Yeah, the beginning of 2027. So we now have 3 years from
Mhm.
that point
From that point.
to get all of these
Correct.
done. And, maybe it is worth packing on a few more million, because we're going to a lot of trouble and it probably
It
doesn't.
will take as much money as you give them.
Right,
And
exactly.
keep in mind too, that if you spend reserves, you can get reimbursed up to that six and
Up
a
to
half
the six and a
million.
half. And I assume that scales with the total. So if it's 19 million, the 6.5.
6.5 was the dollar amount fixed in the reimbursement resolution.
That was the resolution.
Ah,
At the time, we were thinking a $12 million issue, right? Because it was downsized. So that was where the 6.5.
okay. I see. Okay. All right.
Sorry, I had one other quick question. Could we also get a better handle on FEMA forecasts for the next 3 years? Given that the rate study assumed 36 million, I'm assuming we won't get that amount, but it'd be good to know what we do get relative to planning for what our cash needs to be.
Yeah. Well, right. I mean, right now, the projection, that's not even FEMA. Yeah, we'll get it for you.
Yeah, because what would be ideal is an integrated cash flow projection over the next 3 years, showing CIP projects coming in, FEMA grants being obligated, right? Because that would go a long way, I think, to
Paid.
make.
Not obligated, paid.
Well, yeah, paid is better, but at least obligated, I think it's a legal obligation, right?
Yeah, but
Money
from
set
a cash
aside.
flow point of view, it's paid, not obligated.
Yeah, paid is always better.
So, you didn't, recommend a motion to us, Jason.
There was no motion. It was just the staff to.
Are you, do you have the feel that the board is saying yes? Or what do we need to do to say, I think we should be proceeding with this?
Yeah, we need, I mean,
So you do need us to say something that I think.
Yeah, it doesn't need to be in a resolution form. It just, basically kind of go around and say, what do you think? What do you think? What do you think? And so on. And just that would help us in the direction, very much so.
it can be a consensus. It doesn't have to be a formal motion.
Okay.
So
Okay. Director Largy?
I feel like we're heading in the right direction. I look forward to getting finer resolution on the sequence of things. And I think that I would like to understand more about front loading payment through the PAYGO method and the implications for perhaps bearing a higher rate of interest early in the series to complete debt service sooner and retain capacity in out years for future loans, which it was just to say, I guess I'm concerned about the interest only payment issues. I don't know how to, what I don't know is what analysis. I can't picture the analysis that will give me more comfort. So anyway, that's my
Director Russ?
There's been a lot of information here to digest, and it does sound like we're going to get some additional information, which I think will be very helpful, getting me a little more comfortable with, is the number 16.5? If we can get 19, that actually might make sense. Because depending upon when FEMA comes in, maybe we don't need to take out another 15 million in 28, right? I mean,
let's hope that's the case, right?
Let's hope that's the case, because
Yeah.
no interest payments on that. No, I think this is a great start, and I look forward to just getting more information, especially about the 3-year cash flow, whether it be quarterly or whatever. I don't know what's the easiest, and have FEMA come into that, and the CIPs, and then some idea about how sensitive is it, right? If our operating expenses, to Bob's point, are continue to escalate more than we are projecting, what does that do to us? And just kind of see. And yeah. So anyway, I'm very much thumbs up, and look forward to getting some more information. and
Okay.
having another discussion.
Okay,
Thank you.
Director Fultz?
Yeah, I mean, I think the consensus around do we want to get a loan is yes. But the devil's in the details around how much, what the amortization options are, uh, looking at the validity of the cash flow projections, folding FEMA in, all those things. That is where I don't know that we have complete consensus yet. Okay. So, but on the need to get a loan, I believe we have complete consensus on that.
Okay, and I concur with consensus. Yes, we do need to get a loan. I do want to see how our cash flow has changed since the projections that were put into the rate study, which was done. The analysis was done 2 years ago, and I don't want to depend on that going forward into this. Oh, well, this is what the rate study said. In particular, to Director Fultz's point on our operating costs, we should be using real or current information to go into that. But yes, to going ahead with this or with this analysis.
If I can ask one question, then would it be the intent of the board to consider this bond issuance in the March-April timeframe? Assuming between now and then you guys get the information that you need to sort of get comfortable, is that a reasonable timeframe for us to bring that to you?
I think coming back sometime between now and final with an update of information would be helpful. I don't want to wait until March, April to say, here's the final. Are you ready to say?
But no, you know what I'm saying is we would bring the bond documents and approval of the bond
Yes.
issue March, April. In the interim,
Yes,
Jason and Sheree can work with you guys to
Yes.
get you the information to get you comfortable to be able to approve in that time. Is that
yes,
reasonable?
I believe so. Yes. Yes.
Assuming that Jason and Sherry nod their head that they can deliver the information in that time frame. Yeah,
Well,
I believe it's
I
true.
see Jason nodding his head. Yes.
cool.
Okay. All right.
Thank you.
Okay.
Thank you very much.
Thank you
Well,
for
thank you.
comprehensive
Thank you both for
presentation. Okay. We have one item on the consent agenda. We still need to go through the rest of the meeting, board minutes. Anybody want to comment on those or make a? Okay, without seeing objection to that, we will consider those approved. We have no written communication.
Point of order, Mark. Sorry to ask this, but did we then settle on the notion that we don't have to make a motion and approve the consent agenda?
Are there accounts payable in the consent agenda? Sheree? Then there's no motion needed.
Right.
Okay,
If it's
good.
just the minutes.
Okay, great. Thank you.
Okay. With that then, we can adjourn this evening. Okay.
Yay.
Thanks, folks.
Good night.
Good night.
Good night.
Good night, Marty.